I think Polygon's dead if they don't, somehow develop some sort of ecosystem fund. Like you just can't compete with Arbitrum, Optimism, etc., being able to hand out token incentives and bring users over to your chain. I can't get over that point. Like even if you look at Gains Network, that was a Polygon native protocol that migrated over to Arbitrum as well. They have two versions live every single day. It's 85% of volume on Arbitrum. They literally just got a stip worth, I can't even remember. It's in the $5 to $10 million range. Like if you're not getting that on Polygon, like why wouldn't you be on Arbitrum? Hey everyone, Sam and Dan here. And before we dive into today's episode, I wanted to shout out Metamask Portfolio. Are you always constantly stressed like us managing your portfolio across different chains, wallets, LP positions, perps positions? I'm excited to tell you about Metamask Portfolio, which lets you manage all of your crypto assets across different networks, wallets, all in one place.
Do more with Web3 your way with Metamask Portfolio. You'll hear a little bit more about it later in the show.
What's up, everyone? Welcome back to another episode of 0x Research. Before we dive into today's episode, a quick word from our sponsor, Hexens, the most hardcore security team in Web3, pioneering in zk and novel cryptography. Hexens is trusted by tier 1 projects like Polygon, Mantle, RiskZero, Lido, 1inch, Nubank, and more. Check them out on the ground at DevConnect, and be sure to mention 0x Research when requesting a quote, and you'll get a free WebTube pen test with the purchase of your audit.
What's up, everyone? Welcome back to another episode of 0x Research. We got a great analyst episode queued up for you today. We're joined by 0x Pibblez and Ren from the Blockworks research team. We're recording this on today, October 23rd. And so this episode will drop in 2 days on the following Wednesday on October 25th. And again, we're joined by 0x Pibblez and Ren to kind of bring all of the latest market happenings to you. And we're all part of the Blockworks research team. And if you're interested in checking out some of the cool work we've been doing, be sure to use code 0xresearch10, all caps, for a 10% discount at checkout. We just launched a new analytics tab. We'll get into a bit of that a little later on in the episode. We're going through some of our governance updates, but do be sure to check it out. If at the very least, scroll through our Twitter. We got a lot of our good stuff going through that pipeline. But to kick things off today, we'll do a little top mover, biggest loser. So Sam, I'll kick it over to you to get us moving.
Yeah, for the mover, this one felt like a pretty easy one this week. Bitcoin dominance, definitely in the driver's seat. It feels like we're nearing up to like 53%, which is the highest level we've seen in a while. As people who have been here in previous cycles are familiar with, usually Bitcoin dominance goes up and then altcoins kind of rally towards the more frothier part of the market. So it's always encouraging to see that price action. We saw BlackRock made an amendment to their S1. Not sure what the hell an S1 is, so don't ask me. But basically to see the ETF with some cash, so it looks closer to approval. Not sure if that has much legs or not, but nonetheless, people on Twitter were talking about it, so it seemed important. Plus, CME futures open interest, which in my opinion is the best gauge at, I guess, U.S. Institutional demand, more on the TradFi side, is at highest levels since early 2022. And you've got Bitcoin supply on exchanges at a 5-year low, which I found super interesting. So yeah, Bitcoin dominance, definitely the top mover this week, but we've also got movers out of Link and Sol, both kind of moving pretty hard. I don't know if you guys have any thoughts on this section here.
So you just mentioned the amount of Bitcoin on exchanges, and with Bitcoin, there's only so much on-chain analytics you can really do. But people try to get every inch of, like, really squeeze every drop of water out of that. And so the Bitcoin on exchange is one I find quite interesting because I get the idea behind it, right? If you're sending tokens to an exchange, you're one step closer to selling them. So that's kind of like a fear metric. But how much credence do you guys give to that metric of being like, oh, if there's a ton of Bitcoin on exchanges, like, look out below? Or if there's like little to no Bitcoin on exchanges, well, that means that nobody's going to sell.
To be honest, not really. I would even go so far to say all of like those like fancy metrics that they have for Bitcoin on like CoinGlass, or that like one website with like a ton of like fancy like miner or like whatever metrics. Like I don't really look at that. I feel like it's kind of like overthinking it. Even like coin holder days, and like they've now multiplied that by like something else. Like I think it's just too complex. You just have to like left curve it at this point of the market with like a spot Bitcoin ETF coming up, right? We had the whole like Cointelegraph like fake Bitcoin ETF news last Monday. And I think this weekend's move was sort of like an after effect of that, right? I'm not sure if this move would have happened without that Cointelegraph move, because that thing got announced, the market pumped 7.5%, and then everyone's like, oh shit, like what if the real like spot Bitcoin ETF gets announced. I don't want to be sidelined off like a 10-15% pump. And so like the market, people start deploying, people start buying in because they don't want to miss out on the real thing. And it just results in the price like slowly going up.
Yeah, on the BlackRock ETF thing. So Sam said that S1 filing had an amendment about seeding the initial product with cash. So I think it specified like it said like October blank, which kind of implies that they're going to use cash to buy a ton of Bitcoin potentially in October, which makes sense. Like if you're going to start this product first, you got to get the actual asset that you're offering exposure to. But I'm curious to see like what the custody situation is for that, because we're all kind of assuming Coinbase, and hopefully that's the case.
Yeah, another interesting thing that I noticed here was, the holiday season's right around the corner, so I got to start prepping my responses to, wow, do you still have a job? And that started with pulling up the S&P versus Bitcoin year-to-date performance. The S&P is up 11%, and Bitcoin is up 86%. And that was like I knew we've been performing well since a lot of the fallout from last year, but damn, that's a big margin. That one feels good, and I will absolutely be using that chart. And if that doesn't quite look the same for ETH as well, by the way. I don't have the ETH chart pulled up in front of me, but Bitcoin has had a great year, and so it's no surprise that dominance is really kind of kicking us forward here.
Yeah, absolutely. Plus, I was writing the newsletter earlier this morning, which, by the way, everyone should subscribe to if they haven't already. It's very good. But basically, the share of hash rate owned by public miners is at like an all-time high right now because they're kind of buying like the distressed, less well-financed miners assets. So I think they're going to perform super well, and they already have. They're actually outperforming Bitcoin pretty much by double. So I'm sure that's definitely catching some like traditional financial market players eye, kind of thinking, man, this is like really high beta to an already like really volatile asset. So maybe adding a 0.5% allocation there would make a lot of sense. But I think that's a good spot to head over to the biggest.
I want to add some more context there. So I just quickly pulled it up, and ETH is actually up 40%. So it's kind of straddling the 11% of the S&P and the 86% of Bitcoin. And so interestingly, the Nasdaq is also right around 40% at 35. So that's kind of ETH is kind of trading more like tech stocks, whereas Bitcoin's just beaten to its own drum. Very interesting.
That is interesting, actually. I wouldn't have guessed ETH to be on par with kind of the mega caps in the stock market, but that's a good call out, Dan. But for losers, I've got just sideline folks. That's pretty much the only loser I could think of because everything else is up today. And I'm sure when this drops Wednesday, a wrench will be thrown in this commentary. But nonetheless, on Monday, that's definitely the way things are panning out. I'm curious, just based on the sentiment you guys see on CT, does anyone have any, I guess, projections or predictions on like what percent of crypto Twitter participants are sidelined on this move?
I just don't know how you can be sidelined when you sit here and like if you're posting tweets all day, like you got to be exposed, or like you get way too much enjoyment out of just shit talking online. I've been saying life is a lot easier when you're already all in for 6 months now, 7 months. So I mean, I gotta imagine that it's a majority of people just based on the sentiment we're seeing on CT. I don't know. I feel like I don't know, maybe it's about half and half. I take it back because I feel like for every one bull post I see, I get another one that's just like pure depression, and I'm like, all right, like just allocate. Why are you waiting? If you think something's gonna 10x, you have no business waiting for like a 10% move lower. Like just get in. Not financial advice at all. I'm a horrible trader.
Yeah, I'd agree with that to some extent, but I also think like when you're sitting there looking at this stuff day in and day out, you can kind of drive yourself absolutely insane looking at price action, and the industry moves so fast that I could definitely see yourself like overthinking it and waiting for, lower prices. But any other thoughts on this here?
I just think from experience, watching everything rip and not having any exposure to it is probably more painful than actually losing money on something, which is why I got in.
The FOMO is real. I definitely agree.
All right, everyone, let's take a moment to hear about Metamask's portfolio. If you're like me and Sam, managing your crypto assets across different wallets and networks can be so overwhelmingly complicated. That's why we're excited about Metamask portfolio. All you have to do is connect your Metamask wallet to get a bird's eye view of all your coins, tokens, and NFTs in one place. You can easily buy, sell, swap, bridge, and stake crypto assets at competitive rates, all within the app. And you get to choose from a vetted list of providers. There's no more jumping between dozens of sites and apps. Metamask Portfolio lets you do more in Web3 your way, giving you secure and convenient access to a wide range of features and services all within one place.
Manage your portfolio your way with MetaMask Portfolio. Peep the link in the description of today's episode to get started now. Dan, you got some governance updates for us this week?
Yeah, for sure. So we can start things off. Adam always has pretty crazy tokenomic discussions, or honestly just governance forums on the whole. But right now they're discussing a proposal to lower the hard cap inflation. So they want to lower the max bound of the dynamic inflation from 20% to 10%. And the current inflation is sitting around 14%. So this would basically, right, if it were to be implemented, it would immediately reduce Atom's inflation by about 30%. And so compared to other proof of stake chains, the hub is like vastly overplaying for security by about 2 to 3 times, because most chains are somewhere between the range of like 5 to 7% of inflation. And so, obviously this is a very heated discussion because it directly impacts the bottom line for validators. And so like they're obviously going to be a little bit reluctant to just like reduce their net income. That's a pretty understandable position for them. But the reality is, if the hub is just like throwing tokens out the window for no particular reason, probably some reason to kind of throttle that back and maybe reduce the amount of security that they need to be, or reduce the security budget essentially. So we'll wait for Effort Capital to come back on and give us his full thoughts next week. But that is definitely worth something pointing out if you're going to see a 30% reduction in the inflation rate of Atom. And then we also have Ibuko, which is the leading DEX on Starknet by volume. They had a recent proposal to kind of make a $3 million or 3 million token contribution from the DAO to collect Uni tokens themselves. So basically they're saying, all right, we'll take on 3 million Uni tokens and provide you 20% of our protocol's future governance token, which is a really, really interesting proposition. And so I personally don't feel too strongly about this, but Sam and Pibblez, I know you guys both kind of have two different perspectives on here. So I'd love to get the breakdown.
Yeah, I can start first here. To be honest, I've never used Ibuko, so I can't say I have like a super strong yes opinion, but I see all this drama going on in the Uniswap DAO, and they have so many Uni tokens in that treasury, and token holders just have virtually zero rights. So I don't know, a treasury swap kind of makes sense to me. Plus, you'd imagine in the next year or two, Starknet will pick up a lot of steam as one of the few differentiated L2s, and a potential airdrop coming as well. So I kind of like it, but then again, like token holders really don't have that great of rights. So even if they do like a treasury swap for like a future allocation thing, I don't know how much benefit it actually has. But the way I'm seeing this right now is just try something. And if this can accrue some value to the Uni token sometime down the line, I think that's a win.
So there's a couple things to unpack here. One is the founder of Ibuko used to be a dev at Uniswap back in the day, and then he was an advisor to Labs for a little while. So that's like the background of like why he popped up in the forum to ask for this. But I think it's a pretty bad deal for Uni holders and just like the DAO in general, because it's basically just like they're getting, or Ibuko's getting like 3 million seed funding to fund operations for their DEX on Starknet that is not going to really benefit Uni at all. Another thing is Ibuko wants to be considered kind of like a core contributor to Uniswap, which is weird because although they're using like their own version of the singleton contract on Starkware, like it's written in Cairo. So it's going to be kind of hard for them to like contribute as a core contributor to Uniswap if everything they did is in a different language. Like I just don't really see the point of this. And then like further, like, all right, he wants 3 million Uni tokens. He's going to use that to fund his operations, but like that's all going to be up to his discretion. Like there's nothing clarified of like what's he actually going to spend it on, what's his projected spend, like what a timeline is for a budget or anything. So I think there's just like a lot of red flags with the initial proposal. So it definitely needs to be hashed out more.
I also come in and chime here. It's not like Starknet has like a thriving DeFi ecosystem. Just looking at DeFi Llama right now, they currently have 33 million in TVL. The top 6 protocols are Jedi Swap, MySwap, zkLend, 10K swap, Ekubo, and sif swap. I guess they have a really like strong hard on for like Star Wars memes. But yeah, I feel like Uniswap is at the stage where they're big enough that they have sort of like dominance over the market in terms of spot dexes, at least in like the vast majority of ecosystems. And they're at the stage where like even if someone else does something like innovative, Uniswap can just like copy it, take it in house, and sort of like just price other people out of the competition. Kind of the same thing where like Amazon will like see like a popular product or manufacture it themselves, and then they'll sell it themselves rather than letting like a third party merchant like sell it on Amazon. And I feel like this deal makes no sense for Uniswap, especially given their scale. They don't benefit a lot from it.
I wonder if like some of the rationale though is like, hey, like Uniswap, like you want some exposure to the Starknet ecosystem. I don't even know if Uniswap is actually live on Starknet. So if they are, then this is an old point. But nonetheless, I feel like to not have to devote resources to building out something in a completely separate language and just having another team do it that already has 70% of DEX volume on that chain, it's kind of a good way to gain exposure. But definitely hear your guys' concerns with like, yeah, like you're just going to give us these tokens and we have no idea what you're doing with them. You're probably just going to sell them and then fund yourself to sit on the couch for a while. Like definitely a real risk.
Yeah, for sure, for sure. Those are some good points there. Just a really interesting development, though. I haven't seen a lot of like these token swaps go through, especially for larger DAOs like Uniswap. So I don't know. This could have started a new precedent if it is A, executed, and B, goes well. So it's definitely something to keep an eye on. Another governance update we have is Aave for proposing to further increase the Go borrow rate from 2.5% to 3%. A lot to think about here because so Go launched in I think June or July timeframe, roughly earlier this summer, and it has greatly struggled from a peg perspective. So right now it's trading about 96.6 and has just really been down only since launch. They used an artificially low borrow rate when they launched. I think it was around 1.5%. And what that did was create some great initial demand, but what they did was, let's say you borrowed against ETH or whatever your asset was, you'd take out your debt position in Go and then immediately sell that on the open market and just either like loop the strategy or just get rid of your tokens and go execute some other thing. Like if I wanted to, take some leverage out and go long ETH, I would open a position, borrow some Go against my ETH collateral, and then sell the Go for more ETH. And now I'm holding an increased amount of ETH and I have more exposure. And so what this did was just destroy the peg. And so they've already raised the interest rate once, and now have another proposal to go from 2.5% to 3%. They also launched without a PSM. And so the PSM is great for upside peg protection, but honestly, it doesn't have a huge impact on the downside peg protection. Really, how you solve downside peg protection is like having a robust ecosystem for your token that creates demand for the token. Like you need people to want to hold the token and not just dump it into a liquidity pool. It's kind of like this really hard problem you're trying to solve, but that is ultimately kind of the goal here. And so the question here is like, what went wrong for Aave? Like, how did they really slip up? Because if you look at somebody like Curve, who also recently launched a stablecoin earlier this summer, the Curve peg has never dropped below 99.5 ish, so a whole 3 cents higher than what what Go is trading at today. And if you look at what they're doing, well, they have a robust ecosystem of incentives to create that exterior demand and say, hey, go put your assets in this liquidity pool. Don't just go dump them or something like that. Pair them with another stablecoin and earn yield. And things like Conic that sit on top of the Curve ecosystem really help promote that. They launched with their AMOs, so they're what they call peg keepers. So yes, that's much better for upside peg protection, but you're launching with a more complete product. And then lastly, they have a much more robust interest rate mechanism that relies on no governance and is just based on market forces and certain select parameters based on some of initial risk parameters about the asset that you're borrowing against. And things like the Curve price, the CRV USD price actually plays a role in the interest rate that the user pays. So you see these two different perspectives, and ultimately it's all right, well, what does Go, how do you fix Go? And Aave is doing a ton of work going into this. They've created a liquidity committee which is basically a multi-sig of some community participants around all right, we're closely integrated with both Curve and Balancer. How do we use vCurve or vBal or some of the yield aggregators like Convex or Aura that sit on top of those to really kind of create the deepest liquidity we can to help promote peg strength and things like that. Now they're talking about increasing the interest rate again for an additional time, right? Because if you have an artificially low interest rate, people are going to like loop SDI or sFrax yields from you. And again, that's just going to all get sold back and negatively impact the peg. So they're kind of going about the right steps, but so far, like really, really lacking in demand. If we look at, total demand for, again, comparing Curve and Aave, Curve USD is at about 125 million of borrowing, and we see about 25 million for Go itself. So definitely need to see some increase in the peg stability before you're going to see a lot of traction there. But so far, rough start for Aave.
Yeah, I think SDI and sFrax, as you said, just completely like flipped the stablecoin landscape on its head as we knew it before those two products like kind of came to market. And I expect that to continue, honestly. As a side note, I just think it's so interesting that the US government is basically indirectly injecting like hundreds of thousands of dollars a day into DeFi. Like that is so cool and like so bullish on a longer term time frame, especially as that scales. And yeah, I'd put myself in the hot seat for what I expected Go to do. I thought that was going to be a really successful product, and it's pretty much completely flopped front on its face.
Their only hope is to be a third mover and launch SGO and just try to do what everyone else is doing.
That's a good point, though. I mean, they're going to have to do some sort of off-chain asset strategy or RWA strategy, whatever you want to call it.
Yeah, I mean, Kanto rolled out an RWA strategy before Aave did.
And they're moving to the Polygon CDK, baby.
Does anyone know what's good with Aave Arc? I haven't heard anything about that. It wasn't that supposed to be like their institutional grade, like
I don't think Aave Arc gained like any traction at all. Even though they launched it, I want to say like more than a year ago. Like I think it barely got any like assets or TVO in it. I'm not sure if it's entirely shut down, but it seems like more or less dead right now. And I feel like Compound also launched like an institutional like borrowing solution probably 1 year ago too, and yeah, that also got shut down like pretty early on this year at the end of last year. So all of these like institutions only like lending borrowing protocols, like I don't think they've gained any traction. And I want to say that most of these institutions or like hedge funds are still doing their lending and borrowing with just like normal like desks such as like Amber Group, Falcon X, etc. They're not doing it on chain.
Yeah, I'm confused as to why Compound is still even operating. Like, I don't know a soul who's using it, but there's money in there, and they're mining the token. But I mean, now that Superstate is a thing, like they should just deprecate the whole thing. Go start something new.
That might be like a Justin Sun place of activity. I think that might be a lot of the TVL. I'm totally like making that up off the top of my head, but I'm pretty sure that's where most of the TVL comes from.
I wouldn't be surprised.
But continuing on the idea of stable coins, protocol specific stable coins and their power in DeFi, sFrax is up to 40 million in TVL just a week or so after launch, and SDI is, last I looked, about 1.6 billion, which is insane. Like to your point, Sam, like there's material demand in the middle of a bear market for a product that will get you, that treasury rate yield. So that's pretty cool to see. And a little bit of alpha, something to watch out for in the governance forums is Curve is looking to add SDI and sFrax collateral to their lending market. So you'll be able to execute that looping strategy. There's actually a vote to basically, they're going to use a Curve pool as the oracle for that. And so they're deepening liquidity in the SDI CRV USD pool right now. And then that will become the the oracle for the SDI collateral. And so right now there's a vote up to add a gauge to that pool for Curve, and then you'll see the incentives roll through, liquidity deepen, and then likely the asset will get listed as collateral. So definitely something to keep an eye out there from a governance perspective. But lastly, on the governance front, we have Polygon actually migrating from Matic to POL. I think the launch is slated for October 25th, which is the Wednesday of this week when the episode will go live. So trying to do a little bit of foresight here and see into the future. So, don't come after us with the pitchforks if that doesn't end up happening. That looks like what the game plan will be. It's PIP 26 that suggests increasing the validator rewards by 70 million from 130 to 200 million between now and July 2024. So that 50 million increase to 101 million the following year. 50 and another 50 million increase the following year from 101 to 150 million. Sam, I know you've been paying a lot of attention to the Polygon and their recent development with the zkEVM and their interop layer and all that. So how do you think this is going to impact the future of the Polygon ecosystem?
Yeah, I think it's bullish. I think this is like a necessary migration just to kind of like get a new narrative going for Matic and the Polygon ecosystem. Just to kind of clarify, PIP 26 is actually increasing these scheduled validator rewards / like incentives from now until July 2024 by 70 million. Because I think a while back they had reduced it, and now they're trying to like kind of get it back up to like where it was, because they want to make sure to incentivize the proper behavior, and then another 50 million the following year.
Is this part of that like original 5-year plan that Matic had for like when, because Matic was a hard cap token and now POL's not, but are they going to keep the original 5-year plan for validator incentives, and then like this is the schedule that you're talking about them altering?
Yeah, exactly that. So I think they just want to make sure that they can incentivize, enough validators to want to join. But unfortunately, that does come at the detriment of token holders through extra dilution. I don't think it's necessarily like the worst thing. I mean, we just talked about Adam trying to get from 20% to 10% annual inflation. So when we're talking like these numbers on a 10 billion token supply, it's a lot less. So, the problems could be bigger, but it's just cool in general to see this migration occur, considering like how much of a pioneer Polygon was in scaling the EVM. Like, yes, it's a side chain. They get a bunch of crap for how they market it, but I do think had Polygon not been there, a lot of other alt L1s would have picked up like a lot more traction back in the last bull run. So I do think Polygon's extremely Ethereum aligned. And also, like, they just started taking governance a lot more seriously. So they just launched a security council, basically giving them the ability to do emergency upgrades with no time lock, assuming they have 10 of 13 signers. And the list of 13 signers is like pretty much like some of the top security people in all of Web3. So I don't know. I think they've, they're on the right track, and I'm excited to see where Polygon goes from here, especially once they migrate that side chain over to a Validium.
I think there's two things that I want to see. Polygon hasn't had like the most thriving DeFi ecosystem in the grand scheme of things, and I'm not sure if this like interop or aggregator layer will sort of enable like novel use cases such as like distributed AMMs, but I think there's a potential chance for them to sort of stand out with cool like DeFi protocols that are only possible on Polygon. So I was gonna say Solana just because Solana sort of like made that their narrative. And then another thing I want to see is obviously the token POL itself is meant to be like a multi-utility token, right? You can use it for like stake, just like to secure the Polygon network. You can use it for like the sequencer network, the prover network, whatever. I'm really curious as to see how much adoption that gets from day one, or if it's even actually ready. I'm not really sure. But I think that may be indicative for like how successful EigenLayer may be, like how much people want to use like one token as collateral for like multiple use cases. It's like a test bed, I guess, for like restake DEF.
That's pretty interesting, actually. I haven't thought about it from that lens before, but yeah, I like briefly mentioned this, so I want to expand on it. And one of like the key differences from the token migration from Matic to POL is the fact that they removed the hard cap, so it's now can be used as a staking incentive driver, sort of into perpetuity. I think there's an inflation cap on it, so it can't just like 1 year elect to just emit 100% inflation, but they did get rid of the hard cap, which is kind of interesting because it is a 1-to-1 token swap, just with like some minor tweaks to tokenomics. And honestly, like I'm sure that there's some hate out there on them changing some things like this, but they launched that token in 2017, I would guess. Like, things have changed. There's been a lot of research done on what a token should look like, and the team has been building for the last 5 or so years. Yeah, I would want them to be able to kind of modify what that token looks like and what it can do and what it can be used for, to kind of build out the most robust ecosystem that they can. And that's ultimately what I believe they're trying to do. So I'm pretty excited about their vision. I'm excited about, honestly, the ZK ecosystems as a whole. I think there's a lot there. I don't know when we'll get it, as I think the tech still needs some improvements to really scale. Like, we haven't seen any hyper chains really come into the ZK Sync ecosystem yet that are like, really blow your socks off by any means. And even the early campaigns for who Polygon is going after to kind of build out on the Polygon CDK is kind of in the same boat, right? Like, Kanto is coming over. They were kind of like campaigning to get Celo over, which is like a smaller L2. And it's like, all right, like, those definitely aren't the most attractive change by any means. But what's interesting is because of how the interop layer works, like everybody that's opting into the same interop layer is going to help reduce the cost of proving for each other. And so like ultimately that comes back and benefits the Polygon zkEVM. So you kind of have this like little flywheel effect of like, hey, well, if we're all in this ecosystem, it's cheaper for us. And so it's going to be like this race to see like, all right, who can like actually get the most attractive set of L2s to kind of come join their network. So it'll be fun to watch.
Yeah, I agree. I just add one more thing that I think Polygon's dead if they don't, somehow develop some sort of ecosystem fund. Like you just can't compete with Arbitrum, Optimism, etc., being able to hand out token incentives and bring users over to your chain. I can't get over that point. Like even if you look at Gains Network, that was a Polygon native protocol that migrated over to Arbitrum as well. They have 2 versions live every single day. It's 85% of volume on Arbitrum. They literally just got a stip worth, I can't even remember. It's in the $5 to $10 million range. Like if you're not getting that on Polygon, like why wouldn't you be on Arbitrum? You know what I mean? So that's the one other caveat.
I would disagree. I think Polygon's kind of served as a testament is like, don't blow up and just keep going on and you'll be fine. Like being so old and still being in the game and having processed a lot more like settlement than something like Stellar or like Neo, like those kinds of tokens. Like Polygon is still here. And like, even though DeFi appetite is pretty bad right now, it doesn't even have to be DeFi for like Polygon to succeed. I mean, they've got like the Starbucks Odyssey thing going on. There's just like plenty of other, I guess they kind of have like a brand, even if like crypto native people don't think so. Like they do have a recognizable brand, and people know they can go to Polygon to like try something out in crypto.
Yeah, I guess another counterpoint there would be the interop layer as a whole, right? Like if they can get some liquidity moat around the interop layer, then there may be some external drivers for like why you'd want to be within this ecosystem, which like, yeah, maybe you can go to Arbitrum, get a stip, get some free money and get some short-term usage, but maybe I need to be in this app with everybody else that has, this hub of liquidity around it to really get traction. I don't know. I'm spitballing here, but that's why I'm just like really excited about the idea of this like interop layer. I think that like, Blockworks Research needs to do an in-depth analysis on that because A, I want to read it, but B, it'll be really cool.
Yeah, I know Sandeep as well, just as another point, has tweeted on Twitter like as a reply to someone else saying like, what do you mean we're not going to do an airdrop? Who said that? So like, I think who knows if he's just hyping this shit up, but nonetheless, he's aware that like he needs to get people farming.
What's up, everyone? As we explore today's blockchain landscape, let's take a moment to recognize Hexens, the premier cybersecurity provider in Web3. Hexens is trusted by tier 1 projects like Polygon, including a security review of the new Polygon zkEVM, Mantle, RiskZero, Lido, 1inch, Nubank, and more. Get a deep dive into your technology stack with the most comprehensive analysis in cybersecurity consulting. With over $55 billion secured, they cover everything from smart contracts to blockchain to Web2 pen tests.
There has been nearly $7 billion of total value hacked in crypto's nascent history, so it's safe to say that your team has a lot on the line. Don't skip out, take your security seriously, and choose Hexens. Don't forget to mention 0x Research for a free Web2 pen test with your partnership, and you can reach out to Hexens at hexens.io or find them on the ground at DevConnect. Without further ado, let's get back to today's episode.
Time for a little hot seat, cool throne. What do we say?
Let's do it.
All right. Pibblez, why don't you kick us off?
Yeah, I'll come in with the hot seat, and it's a name that we seldom talk about on here, but it's Polkadot. They have a little over $400 million worth of DOT unlocking tomorrow on like the 25th. And then I think like there's another wave in January. And so basically 2 years ago, people were locking up DOT in the parachain auctions, which was like the ultimate hype machine. And so they locked them for like 2 years, and probably like the average cost basis of someone who locked DOT back then was around like $25. And like now it's at like $4. It's kind of been moving the past few days. But so I think it's like 5 bill circulating market cap. You've got like 400-ish mil about to unlock. I don't really think there's enough liquidity to like handle a mass dump of like 400 mil DOT Open interest is sitting around like 30 mil, so not even 10% of this upcoming unlock. And I'm just expecting like a lot of volatility on DOT for the next few days. And so like at surface level, it's hot seat, like, oh no, DOT's going to go to zero. But then if you look further, like probably the most entertaining outcome is going to be some sort of massive short squeeze where DOT rallies like a 10 NFA. But we'll see. It's going to be really interesting to see what happens with this.
I was scrolling through just looking at activity on some of these parachains, and like, man, it's like the apps deployed over there is no different than like the shittiest L2s. It's just like Dex lending protocol, nothing else. And I don't know. I mean, yeah, I know there was some contention around like I don't know. I guess this takes me. I'm totally derailing the conversation now. But when Compound was talking about like building out in the Polkadot ecosystem, and then like it never came to fruition, but they were toying around with like the app chain idea. It's like, what if they like decide, you know what, screw it, we're going to execute on that anyways? Like, I wonder if that would have changed the game at all. Like, would there be more people who would have said, oh, well, Compound's doing it, so like let's go try to do it or go play with it? And then one of the things that I always see touted about Polkadot is there's so many developers going on, like there's so much development activity, so many developers. So I went over to Token Terminal and pulled up their core developers chart, and like sure enough, Polkadot's in the top 5, but I've never put a lot of credence into that metric because I mean Cardano is sitting at number 1 by a wide margin, and like you're not going to tell me that there's more development work going on Cardano than like Ethereum mainnet or the Ethereum in its L2s. Like it's just not true. So I don't know. I just that's like the number 1 metric I always see touted for for Polkadot. It's just like a hard metric for me to get behind. It's just really easy to fake, and if some dude's just pushing a README update on the GitHub, like that's not development.
Yeah, it's probably really someone just like going in there and changing the font size of different code, and they're just like doing it multiple times a day. I'd also add that like the real nail in the coffin for Polkadot was it called the Nomad Bridge? Whenever that got hacked, Moonbeam, Moon River, whatever it was called, was like the number 1 successful parachain and like supposed to kind of be like the prodigal child of the entire DOT ecosystem. And that bridge hack just like killed it, like completely massacred any chance of Polkadot DeFi. So it's just been real bad since then.
They also took forever on their, I think they call it XCMP, cross-chain messaging protocol. They were like building that forever, and I haven't even gotten an update on that, so I'm not sure if that's live, but I feel like that kind of hurt too with Cosmos having native IBC. But as you were talking, Pibblez, I did pull up Levitas and saw that the funding rate is like negative 33% annualized, and open interest is like doubled over the last 24 hours. So that is kind of an interesting setup. This is going to be one to watch over the coming days for sure.
I think my reaction with all the facts laid out was that like, holy crap, like how many billions of dollars in like DOT were like locked up for the parachain auctions? And I think my first reaction when I learned about parachain auctions was like, why would you only have like 1 month? You're like fundamentally limiting how much your business or your network can make. And it just made zero sense to me when I first like learned about Polkadot and like the entire like architecture. It still doesn't really make sense today.
Yeah, I think the idea behind that was basically let's try and lock up as much supply as we can for 2 years so that way our bags vest when everyone else can't sell. If I had to guess.
Hey, supply sinks were hot. I mean, ETH burn, baby. You got to get a narrative going for your token. I guess counterpoint to my developers comment was, let's take that number at face value and assume it to be true. Then that just takes me back to crypto as a whole's problem of distribution matters. And like, even if you have great tech, you got to get people to use it, and you got to be building things that actually like are useful. So I don't know.
I'll also add that for like active developers count, there's probably like I don't know if this is the correct term, but like a power law distribution. Like your top like 0.01 developer probably has like 1,000 times more impact on your ecosystem than like the other like 99.999% combined. And that's definitely like very true in crypto. Like for example, like Arbitrum and GMX, like sure, maybe they have like 10,000 developers, but if they didn't have like the 5 developers for GMX, would Arbitrum be like anywhere as close to like how big they are today? I don't think so.
That's a great point. I think it's even more true for protocols rather than like applications rather than base layers, right? So something like Curve, Mitch and Fiddy are like what percentage of activity on that GitHub? Like, I'd take them over a team of 100 random devs any day of the week, and most engineers would agree with that. They're like, yeah, I'd rather have one or two, a small team of like powerhouse engineers than a large team of average engineers. The small team or the single person will always outcompete the larger group. There's just, you introduce inefficiencies, and I don't know, if you talk to some engineers, you start to learn that like those dudes just like to operate. It's a different brain. It's a different brain. Sam, who you got in the hot seat or cool throne this week?
I've got Scroll mainnet launch in the cool throne. He probably could have put it in the hot seat as well. It's only got a little bit over 10 million at TVL. I checked out some of the dApps on DeFi Llama that are live, and it's once again just a list of 10 different dexes. So people are just swapping shit coins on Scroll with nothing else to do. They also previously raised at a $1.8 billion valuation. I don't know, man. I mean, I'm happy that they finally, launched. Everyone, I think their team is legitimate. I think they care about scaling Ethereum. I think they care a lot and deeply about crypto. So very happy for the team. But just right now, like between Polygon, zkEVM, zkSync, and Scroll, like they're all lagging. Like you can combine the TVL of all of those, and they don't even equal base. And that doesn't even have a token. And zkSync and Scroll are obviously going to be farmed. So I don't know. I guess I'm kind of curious to see when zkEVMs actually kind of find their product market fit / niche and start to get in the narrative, because everyone was talking about this for over a year. Now they're all live and no one's using them. Like I have only bridged over to one of them personally. I'm curious if you guys have even bridged to one of them.
I think the sole utility of any sort of like zkEVM is to raise a ton of money so that you can get things like Scroll Sauce, this hot sauce that's branded as Scroll. Like I think that's ultimate use case.
How did you have that ready? That is
I keep
actually
it on my
hilarious.
desk.
Oh, that's great.
That's incredible. I mean, yeah. I got like, okay, so Arbitrum and Optimism are obviously crushing all these ZK rollups and activity metrics right now, but they also they got to latch on to some of the bull market growth, right? So like they had developers come in like, holy shit, like we can build on a cheaper version of Ethereum. Like that's awesome. Let's get in there and do it. Whereas, some of the ZK rollups that launched within the last 12, anything that launched within the last 12 months, like you're not getting any love from any new wave of users or builders. So you kind of like trudging through the dirt. So to me, it's not about now, but it's about what will happen in the next 12 to 24 months. And that's really where I think there is the potential for something more interesting to happen again, because you create these ecosystems that can benefit off of other chains in a way that like Base cannot impact, like can't be useful. There's no interop between Base and Optimism, I guess is what I'm trying to say. Or Arbitrum is really just this one L2 that's like kind of siloed within its own canister, where yes, it can have some L3s that live on top of it, but that's still a bit different. Whereas ZK rollups can have like this hyper bridging or this interop layer that just allows for like richer communications between L2s that utilize the same smart contract bridge and the same proving circuits. So I'm really excited to kind of see where that direction goes, but there's no sugarcoating it. That's not here today, and like we haven't seen any of that usage today.
I want to add a few more things here. First of all, I think that valuation that it previously raised at is like completely ridiculous. Like, it doesn't justify the valuation by any means. Second thing is, I think Scroll has done like a pretty poor job at like BD or like just getting their like narrative out there. They're just hiring for a head of growth now, and it kind of feels like it's way too late to be hiring a head of growth, right? Every other ecosystem has like a very prominent researcher or like head of growth, head of DeFi, CEO that like everyone just kind of knows on Twitter. Like if you think about who that is for Scroll, it's not that obvious. I guess like Togu, but like he's just debating semantics with people on Twitter for like 365 days a year. I'm not sure that counts as like getting your narrative and being like a spokesperson for the entire ecosystem. So yeah, I mean like not an impossible task, but definitely like a lot of work for whoever they hire to fill their head of growth role.
Is Ren looking for jobs?
I just saw like Sandy Peng post on Twitter. I don't think I even follow her.
I'm just messing.
I
Yeah,
wouldn't take that job though.
many such cases of great tech and questionable, like a question mark on distribution.
I think what's really going to happen over like the next 12 months is how all the money flocked from all L1s to all these L2s in private rounds and fundraising. I think the all L1s are all going to have their day and like see major applications that are successful that aren't finance related at all. And then like once everyone starts flooding back into the all L1 trade, then maybe the L2s see something. But I'm way more bullish all L1s right now.
Which all L1s?
Definitely, like obviously Solana near is really cool. I just published a report about that, but they're doing some really good stuff fixing the distribution problem, and they have like actual apps that are using it without the actual end users knowing they're doing anything with crypto. I also think like Aptos just launched like some game that's apparently picking up traction right now. So Aptos activity is up, and then Sui is also going to be a really good one. I don't think I'm a fan of Say. I will say that, but I think there's a lot of upside in all these other ones.
Just curious too, while we're on the topic, how do you think the alt layer ones from last cycle perform outside of Solo? So like AVAX, I'm blanking actually right now to think of another, but I don't know. There just seems to be so little going on over there, and like they're like screaming into the echo chamber, and just no one cares.
Well, I think like I'm definitely team Near because NearCon's coming up soon, and like you really can't fade the founders of Near and like how much money they're sitting on. Like they can do whatever they want. Avalanche, like they really tried with Stars Arena and then it got exploited like 3 times. But like apparently there's like that like private DeFi subnet or whatever that Wisdom Tree is allegedly using. So like maybe they have something niche there.
Fair take, fair take. All right, Ren, who you got in the hot seat or cool throne this week?
All right, actually got two. I got one in the hot seat. I'm gonna get to the cool zone one later. So I have Celestia in the hot seat. They recently concluded their airdrop, I think, last Thursday. Pretty shocking numbers actually for what is meant to be hyped as one of like the most exciting like infrastructure projects slash airdrops in the past few months. Only 32.8% of people claim their Celestia tokens. And I like to clarify that there's like three buckets that they airdrop to. So one are early adopters of rollups. So that's probably like normies like you and me. And they got 2% of the total token supply. Another 2% went to stakers and IBC relayers on Cosmos and Osmosis. So they probably all went to it and everyone claimed it. And the last two were basically devs that have been contributing to various ecosystems. If you have a like super big GitHub repo, if you're big like a big modular guy, you probably got part of the 2% allocated. But yeah, 32.8% claimed is a pretty shocking number. It's a good thing that they distributed all of the unclaimed tokens to all of those that claim. So people probably got 2 to 3x their initial allocation. But that muted demand to me kind of signified two things, right? Either the first being that crypto still has a lot of US users and none of them managed to bypass sort of like the VPN restriction. And apparently it was like a quite a bit harder to do so than like bypassing your normal like VPN restriction from claiming an airdrop. So I guess that's probably one thing to take note of. The other thing is that maybe there's just like not that much excitement for the airdrop, especially considering that I think most people only got like $100 to $200. Like that doesn't move the mark, and especially like if you're just like a normie being a degen on L2, like you really could not care less about like modular blockchains, like modular like data availability, execution. You're gonna be like, what is this? $200? Like I'm not gonna bother, right? So pre-launch futures have it trading at 2 billion. You can trade on Avo. There's probably another perp exchange that I'm blanking on. And its previous raise was at $1 billion in October 2022. My take is that I don't think it justifies that valuation right now. I'm not that excited about modular blockchains, to be honest, especially with like the proliferation of app chains within roll-up stacks. Like I just don't see it yet. Perhaps I'm missing something, but yeah, that's my takeaway for now.
I'm gonna feel so vindicated when Celestia launches and it's like a complete letdown. And all the threads over the past 2 years have all been for nothing.
If you want to know how to get 0x Pibblez to hate you, it's write a thread. It's actually that simple.
Hey, I'm the writer of some of those threads, but it's from the Blockworks research account, so I feel like I get a pass. No, I agree though here, Ren. I feel like 1 billion seems pretty ridiculous, but I do think that the FDV of the token will be 2 to 3 billion. Best guess. I don't know what's it trading at on Aave right now, if you happen to recall.
Yeah, so Avo's at $2 billion. So like
Oh, okay,
double
gotcha.
its last raise at 1 billion.
Okay, yeah, I definitely attribute it to just making it super hard to claim for VPN people, and the fact that 33% of people claimed. I bet 20% of that is people who are witty enough to get around the VPN wall through some niche method that people were sharing in Telegram chat. So I don't know, kind of depressing that 90% of crypto usage, in my opinion, is probably US users.
It's going to be really exciting to see if Eclipse does really well as an L2 on Ethereum using the SVM and using Celestia for DA. Because if they pull that off and like let's just say they absolutely crush it, and for one reason or another that gets attributed to using Celestia for DA, that'll get really, really interesting, right? Because if you are an L2 today and you can cut your cost by 95% by switching from Ethereum DA to Celestia DA, at what point does your DAO start pressuring you into do this? Or at what point does the, maybe it's a more centralized chain, at what point does the centralized team start pushing for this? Or do investors start pushing for this? Like, when does it make sense to say, maybe I break some ETH alignment and actually go use Celestia for DA? So I don't know. It's going to be interesting to see who else gets over there to kind of like prove the Celestia use case. But Eclipse has definitely got, a very interesting shot at it for sure.
I'll chime in here on Dan's point of like pressuring your DAO protocol to like move over to Celestia for DA. So last Friday, Celestia themselves launched this thing called Blobstream. I haven't looked into it too much, but it basically allows you to stream your DA in like a modular fashion to Ethereum mainnet. I'm just gonna read the tweet here. Succinct Labs also announced Blobstream X, right? It's a ZK Lite client based implementation of Blobstream, which streams Celestia's high throughput verifiable DA layer to rollups settled on Ethereum mainnet. So it seems like there may be some like middle ground. You may not have to choose like either or, and maybe there's like the best of both worlds that developers can tap into. But as like a standalone solution, just off the top of my head, it's hard to see again like a huge amount of like outsized adoption.
You've also got to get enough people running light nodes, right? Because that's the whole scalability model of a DA layer, is that like the more light nodes you have, it kind of logarithmically scales. So I don't know. I'm a little bit bearish on the idea of people actually wanting to do that, but the Celestia team, like Nick White, have been doing a really good job marketing it at the very least, taking all the pictures of running a light node on random places on random devices like a Game Boy or something, which has been cool.
Yeah. All right. For the cool drone this week, I have Circle. I feel like Circle has been like launching a lot of like cool, exciting stuff. Just last month, they launched like Circle Research, and they launched their perimeter protocol, which is sort of their like real world asset protocol securitization, blah blah blah. But last week they launched Circle Gas Station. So this is basically Circle's really strong move into account abstraction. What it is that Circle has a gas station that handles sourcing and transferring gas tokens, so developers can focus on building their apps, right? Basically, a developer can define gas policies, manage sponsorship rules, the number of transactions that they want to sponsor, and Circle will basically pay for you, right? So whatever users pay, Circle will pay for you through the account abstraction and like a paymaster contract. But interestingly, Circle's charging a 5% convenience fee onto that. And it's billed at the end of the month. You don't need to like stream it on like a per transaction basis, which I thought was a very interesting model. And yeah, Circle also recently launched programmable wallets. I think probably 3 or 4 months ago. So I'm not sure how much adoption wallet as a service has gotten, but I think account abstraction has definitely gotten like a lot more adoption than people think. If you go check out some like Dune dashboards, like paymaster contracts actually have like a surprising amount of activity ever since like ERC 4337 launched. And so I think Circle's one is really exciting. One outlier sort of way that I think I see this contributing a lot to Circle's like top line is if USDC obviously is like a multi-chain token, especially with CCTP. Chances are you're going to be using USDC on multiple blockchains. And so in the future, if you launch a wallet and you want to sort of give your users the option to transfer USDC to multiple chains to CCTP, can Circle basically use the gas station for that and charge an extra 5% on that, right? And so 5% of gas fees may not seem like much, but I would bet over time, especially if stuff such as like SAP, like using USDC, that kind of stuff really takes off. And if you're like an institutional like logistics client, right, you're not going to be wanting to use like USDC in a wallet. You want all of that abstracted away. Like 5% on all of those like transfer and gas fees could probably make a lot of money for Circle in the long term.
Just imagine being SAP though, and like getting your monthly bill saying they integrated this month, and you're like, okay, nice. It's only like a few $1,000s, and then in the middle of a bull run, it's like 30 grand, and they're like, what the hell's going on here? Like, I don't know. This seems like more of a headline in my opinion, and something that won't get that much traction, to be completely honest. But hopefully I'm wrong, because I definitely commend Circle for trying their best to make the UX a little bit better.
Yeah, I'm all for abstracting away crypto from crypto apps. Like, I think that's definitely net bullish. And it's interesting though that like this is running on Polygon actually, which is I don't know. I found that pretty interesting. I wonder if they're going to keep it there or move it somewhere else once it rolls into a Validium. Like, I don't know. Circle does an interesting job of like building out developments across many different chains, which I find quite interesting. Like, they're not just like all in on building on ETH mainnet or 1L2 or Solana. Like, they're kind of a little bit of everywhere.
Yeah, I'll add on to that. Circle recently announced CCTP on Solana testnet. So it seems like that's coming live soon. I think CCTP is also coming to Novo like really, really soon. So like Circle's definitely leaning in very heavily into like a multi-chain future and like supporting developers, so to say. With that, I think the 5% convenience fee ties pretty well into a Uniswap interface fee. So I'm gonna pass it over to you, Dan.
I was just getting ready to use the same segue there. That's beautiful. But yeah, egregious. How dare Circle charge 5% for their interface? No, I'm kidding. I've got Uniswap Labs on the hot seat this week for the community's reaction to their interface fee. So quick TLDR and some statistics around this. There's a 0.15% fee on all swaps that go through the official interface. So that's going to be Uniswap X, the Uniswap front end that you go to, like the traditional front end that you're used to using, and I believe the mobile app as well. And so in about 6-ish days, they've done $280K in fees, which annualizes to roughly about $15 million of total fee revenue. And that's in the middle of a bear market, folks. So like, you could easily see double that once things start heating up and there's more transaction activity that's really just happening on chain. And people were really, really fired up about this. But like, hey, like, you're charging your users for the benefit of Uniswap Labs, and none of this goes back to token holders. But the reality is, like, the person that is using a Uniswap front end is like provably price insensitive. They do not care the price that they're getting on their execution, because if they did care, they would not be using the Uniswap front end. You'd be using an aggregator. And it's important to note that the fee only applies to a certain subset of tokens, right? So this is going to be like a couple stable coins and ETH and wrapped ETH. And it doesn't, like, wrapping from ETH to wrapped ETH doesn't cost anything, or stablecoin to stablecoin swaps doesn't cost anything. So like, the large driver here is definitely the ETH and USDC pair. And if you're going to swap ETH USDC and you're hitting the Uniswap front end, like, you literally do not care the price you're going to get. Like, if you're paying an extra 0.15%, you don't even know it. You never even cared. And so where that activity is kind of coming from on it, because it's across all chains where Uniswap front ends are deployed, 230 of the 280K is from Ethereum, and then another 35 of that is from Arbitrum, and some of the other L2s kind of are quite small actually in comparison to those two. And so the Uniswap Universal Router, which is what the front end will hit, is the vast majority of this volume, with Uniswap X coming in second. And then there's an interesting case for the single largest fee a user paid was $4,000, a little over $4,000 on what was a $2.7 million swap from ETH to USDT. And I think that is absolutely wild that somebody was making this transaction and just pulled up the Uniswap front end with $2.7 million of ETH and was like, boom, I'm going to make this swap. So they ended up paying an extra $4,000 in fees and they got sandwiched. So absolutely brutal. Like if you're moving that kind of size, like A, you need to be using an aggregator, and B, you need to be using something that'll protect you from MEV, like a Flashbots endpoint. So another thing to think about there. But the large uproar was really centered around the fact that most people felt that there was a huge chasm between Uniswap Labs equity holders and then Uni token holders. And that's definitely true. The incentives aren't aligned one-to-one. But I don't think that they're as far off as people really make them seem. And like they make labs out to be this like really ill-intentioned group that is really only extracting value from Uni token holders and giving it to equity holders. That said, there is no doubt that the Uniswap Labs team has a duty to their shareholders to maximize the shareholder value. Like that's what they need to do. However, I think Uniswap, the protocol, plays a very pivotal role in achieving that goal that Uniswap Labs has. And sure, they could be successful if Uniswap protocol died tomorrow, but their likelihood of being successful probably drops by about 97%. And so because of that, like, yes, I do think that they need to create the best protocol that can ultimately return value to token holders. I just don't think that's today, because the debate is like, the community has been talking about turning on the Uniswap protocol level fee switch forever. But all that does is take revenue away from LPs who are already getting kicked in the teeth. Like LPing is a wildly negative EV experience for a vast majority of users. And a lot of this liquidity comes from, 10, 15 different LPs. I promise you that Uniswap Labs is talking to these LPs, and those LPs don't want to give up their fees. So do you really want to go piss off the 7 to 10 people that are supplying liquidity to your protocol? And if you do and they leave, then you don't have a protocol anymore. So you don't have future fee revenue to get. And there's been some good studies done around like hypothesizing how you'd go about turning on the fee switch and which pools you would use and like which chains you'd start on and like really kind of testing the waters. But that's all you're doing is testing the waters. Like it doesn't make sense to me at all to say, hey, we know LPing, you're going to lose 5% while you do this, but us, the DAO, we want to get a couple more percent out of you, and we actually want to turn on our own fee switch. So instead of losing 5%, now you're going to lose 9%. Like that doesn't make any sense. So if you want to be returning fee revenue to your token, you got to be like, there needs to be excess cash to distribute, because even if you diverted this, 15 or so million dollar front end fee switch to the token holders instead of the Uniswap Labs team, that equate to like a roughly 0.5% dividend rate, basically. So what's more valuable to the protocol itself, a 0.5% dividend or reinvesting in Labs, who is incentivized to make the best protocol possible? And to me, it's like very, very clear that you should be reinvesting in the developers rather than and kind of like building towards future growth. And like, there's a lot of things that future growth can look like. You can be, enhancing an existing product or building a new service line or funding more research into LP profitability, for example, literally anything. And so to me, it's very clear, but the rest of the community does not feel this way. It's kind of a controversial take to say you should reinvest in growth rather than distribute to the token holders. So, I mean, yes, I see the chasm here and I see why people are upset that there's this difference. Like Uniswap Labs is not really maximally aligned with the token holders because of the equity. And I see how that's like a fundamentally flawed model, but I don't think it's like the be all end all. It's like, oh, well, Uniswap's done. Like they could go build some ancillary product that's funded by this $15 million of revenue from the interface fee switch that feeds more value to the Uniswap protocol. And then that's how the fee switch gets turned on. Like that's a very probable outcome. And everybody seems kind of like blind to that acknowledgement. So I don't know, rant over, but I just don't think it's the end of the world that people are making it out to be.
Yeah, I definitely agree. I mean, if you think about like before the interface fee switch to date, Uniswap Labs has literally made like $0. A company needs to make money eventually. You can't just fund it with VC funding and not make any revenue into perpetuity. It just like doesn't work. So I don't really blame Uniswap for turning on the interface fee switch, and I think like making it just for Uniswap front ends is like a very, very fair way for them to do so. And I also agree with everything you said about sort of like reinvesting protocol like profits, right? Like even if you think Uniswap has won like the DEX competition, even if you think say like DYDX has like dominated the perps market, right? Even if you think like Ethereum is like the best blockchain on planet Earth. The truth is, like, with the current users on chain today, like, no one has won yet. Like, the market can very drastically change in the next like 2, 3, 5, 10 years, right? You should be like building up that war chest and deploying it in order to like think of new product lines, like increase your moat, whether that's like liquidity moat or like a branding moat, sort of like differentiate your product better and just build an overall like more valuable product. You shouldn't be giving that out to sort of like governance token holders. And I think that's another thing, right? We've always, I think a lot of people like know that like governance tokens are meant to be just governance tokens, but they always see it as equity. And so they always like price and value it as equity and also expect things that like equity and like securities get, e.g., like dividends. But if you think about like governance tokens, they're like literally meant to be governance tokens, right? If it's truly a governance token, should Uniswap be trading at like a $3 billion valuation? Probably not, to be honest. If it's truly can only be used to like vote on snapshot votes. And yeah, I think my final point is that I do have some gripes with like a token plus equity duo structure, just because for like the same revenue generated, like you can't disperse it to both parties, right? It can only be either or. And I think that definitely is a problem for sort of like incentive alignment and value accrual. Probably the best case outcome of this whole like token plus equity dual structure debate is that in 10 years we get tokens that are essentially programmable equity. They get officially like listed as like securities and like they're well regulated and whatnot. I think that's the best case outcome, because with token plus equity dual structures, there's always going to be this debate about like value accrual and incentive alignment, and it's just like a fundamental like fact of nature that you cannot change.
Yeah, I like that you brought up the point about tokenomic design here, because the irony is Curve has returned about 100, but somewhere between 100 and 120 million dollars of revenue to the token, and it can do this because the token plays a very important role within the ecosystem. And that like it uses VE tokenomics, it needs locks, so to incentivize locks, it distributes these like dividend like returns to the lockers. And that's why it can afford to do this, and it's not just like wasting money. Like the token plays a very dedicated role within the ecosystem, which is in complete contrast to a pure governance token. So I appreciate that you brought that up, because like that's the ultimate point here is if you want dividends at a very, very early stage protocol, like the token must play a role within the ecosystem, or else you're definitely better off reinvesting that capital in growth, because you're reinvesting in the most high growth industry that there is, which is what I believe to be the most high growth industry in crypto. And so, yes, like you have to beat the cost of capital in order to reinvest that instead of distribute it. And I very much so believe that you can achieve that within crypto, and that's just a better outcome than distributing revenue to token holders.
Yeah, last thought on this point too. I just see a lot of bad takes on Twitter right now comparing like the Uniswap people going, "Oh, well, look at what DYDX is doing." It's like they raked in like 100 million plus in fees over the last few years from V3, and they pretty much have enough capital to last for 6.5 years into the future. So Uniswap didn't have that luxury, as you mentioned, Dan and Ren. They had to actually pay out LPs. Couldn't hurt them by turning on a fee switch, so it accrued to Uniswap Labs. So I think it's just a very apples and oranges comparison, and you really can't even draw parallels between the way the two are kind of going forward.
Yeah, if I had to make like a Web2 comparison, where Uniswap is today is probably like Uber in the first few years. They're probably like dominating like half of the US cities. And then imagine if like Travis Kalanick went to Bill Gurley and said, "All right, we're in a good spot. I'm going to start sort of like giving out profits to equity holders." And then in the next 5 years, they get completely shafted in the Asian markets, in every single Asian market that they try to expand and dominate in. Like, it would just make zero sense.
Yeah, I completely agree, Ren. But that's probably a good place to leave it. So thank you all for tuning into this week's episode. Pibblez, Ren, thanks for hopping on. It was a pleasure to have you, and we'll see you next week.